There is one money move that quietly blocks most renters from ever buying a house, and it is not what you think. It is not the down payment. It is not the interest rate. It is the slow, invisible drain of optimizing for right now. Every dollar spent making renting more comfortable, a nicer apartment, a newer car payment, a subscription stack you stopped counting, is a dollar that never reaches the account that changes your legal status from tenant to owner. The trap is not dramatic. It does not announce itself. It just keeps you exactly where you are. One more year, then another. So here is where you actually start. 3 numbers. Not 5, not 10, 3. First, income stability. Lenders want to see 2 years of consistent employment history in the same field. Not the same job, the same field. If you switched industries 8 months ago, the clock restarted. Know where your clock is. Second, your cash buffer. This is not your down payment. This is the money that exists before the down payment conversation begins. 3 months of expenses, minimum. If something breaks before you close, if your car needs tires, if a medical bill arrives on a Tuesday, this buffer is the difference between a delay and a disaster. Third, credit readiness. Not a perfect score, a ready score. Most conventional loan programs want to see 620 or above. FHA will go to 580 with 3.5% down. You need to know your number before anyone else checks it because the inquiry itself costs you points if you are not prepared. These 3 numbers are your starting line, not the dream house listing, not the mortgage calculator you bookmarked. These 3. Now stop the leaks. Open a separate savings account. Name it something boring and specific, buying fund. Transfer a fixed amount into it the morning after every payday, before you look at your balance, before you make any other decision. The amount does not have to be large to start. What matters is that it leaves your checking account automatically on a schedule so that spending it requires a deliberate action rather than a passive one. Build a baseline budget using 4 categories only: fixed costs, variable necessities, the buying fund, everything else. That order. Fixed costs go first because they are not negotiable. Variable necessities, groceries, transportation, utilities, go second because they flex but cannot disappear. The buying fund goes third because it must be treated like a bill, not a reward. Everything else is what remains. If nothing remains, something in the first 3 categories needs to shrink. That is the whole system. It works on a $2,800 take-home, just as well as it works on a $4,200 take-home. The math is not complicated. The discipline is the hard part, and naming it clearly makes the discipline easier. Credit repair does not require a service that charges you $99 a month. It requires 4 things done in the right order. First, get your utilization below 30% on every card. Below 10% is better. This is the fastest lever you have. Paying down a card from 80% utilization to 20% can move your score meaningfully in a single billing cycle. Second, build on-time history. Set every account to auto-pay the minimum. You can pay more manually, but the auto-pay protects you from a missed payment that lingers on your report for 7 years. Third, dispute actual errors. Pull your reports from all 3 bureaus at annualcreditreport.com. Look for accounts that are not yours, balances reported incorrectly, and late payments on accounts that were paid on time. Dispute in writing. Keep records. Fourth, do not open new credit accounts in the 12 months before you apply for a mortgage. Every new inquiry is a small ding. Collectively, they signal instability to underwriters who are looking for reasons to price you higher or decline. On the down payment, you have more options than you have been told. Conventional loans with 3% down exist. FHA loans at 3.5% exist. VA loans for eligible veterans require nothing down. USDA loans for qualifying rural and suburban areas require nothing down. State and local first-time buyer grants exist in almost every market, and many of them do not require repayment if you stay in the home for a minimum period, typically 5 years. When you research these programs, verify 3 things: who administers the funds, whether it is grant or loan structure, and what the income and purchase price limits are in your specific county. Many buyers skip the grants entirely because the application looks complicated. The money is still there. It is waiting for someone willing to spend 2 hours on the paperwork. Finally, know before you move when buying actually beats renting in your specific market. The break-even on a home purchase is typically somewhere between 3 and 7 years, depending on your local price-to-rent ratio, your mortgage rate, and the transaction costs on both ends of the sale. The costs first-timers miss consistently are closing costs, which run 2 to 5% of the purchase price, homeowner's insurance, property taxes escrowed into your monthly payment, the inspection, the appraisal, moving costs, and the first round of things the house needs the month you take possession. These are not surprises if you plan for them. They are only surprises if you assume the down payment is the only number that matters. It is not. Build the full number, then buy. You have the savings, you have the credit, you have the full number built. Now you have to actually buy something without letting the process dismantle everything you built. Start with the property type because it determines the risk profile of the entire transaction. A condo gets you in the door at the lowest price point in most markets, but you inherit an HOA, a reserve fund you did not build, and neighbors whose deferred maintenance can affect your appraisal. A townhouse sits in the middle, shared walls, usually a small HOA, often lower maintenance exposure than a detached home. A small single family gives you the most control and the most repair responsibility. A duplex gives you a tenant who helps pay the mortgage, which changes the math entirely if you are willing to be a landlord at the same time you are learning to be a homeowner. None of these is the correct answer in the abstract. The correct answer is the one whose cost structure you can actually carry when the second bedroom ceiling fan starts wobbling and the water heater has opinions. Build your purchase price ceiling from payment math, not from what a lender approves. Lenders will approve more than you should spend. That is not malice. It is their business model. Your number is built from PID, principal, interest, taxes, and insurance. Add the maintenance reserve on top, 1% of purchase price annually, and whatever HOA dues apply. That total monthly number should not exceed 28% of your gross monthly income. Write the ceiling down before you talk to a real estate agent. Carry it into every showing like a contract with yourself, because the market will try to renegotiate it every single time you walk through a house that smells like fresh paint. On the loan, the choice between FHA and conventional is mostly a function of your credit score and your down payment size. If your score is below 680 and your down payment is under 10%, FHA usually wins on rate. Above 700 with 10% or more down, conventional typically gets you out of mortgage insurance faster or eliminates it entirely. If you are a veteran, VA is the answer before any other conversation starts. If you're buying in an eligible rural or suburban area and your income qualifies, USDA is worth a serious look. The critical thing is to run actual quotes on at least 3 lenders for the same loan scenario on the same day. The spread between lenders on rate and fees is real. A half point on a 30-year mortgage is not a rounding error. The offer is where first-time buyers give back money they spent years accumulating. Waiving the inspection to compete is not a strategy. It is a transfer of unknown liability to yourself at the worst possible time. Keep the inspection. If the market is aggressive, shorten the inspection period to 5 days instead of 10, but do not remove it. The appraisal contingency protects you from overpaying for a property the bank will not fully fund. Know before you write the offer whether you have cash to cover an appraisal gap and how much. If you do not, the contingency stays. On repair requests, focus on safety and structural issues. Cosmetic negotiations after inspection signal inexperience and erode goodwill on the items that actually matter. Arrive at closing, knowing exactly what is yours to fix and what the seller addressed. The first year is a stabilization exercise, not a renovation show. Keep 3 to 6 months of total housing costs in a dedicated emergency fund that is not the maintenance reserve. They are different accounts for different purposes. The maintenance reserve absorbs the expected. The water heater, the HVAC filter, the gutter that needs clearing. The emergency fund absorbs the unexpected. The job loss, the medical bill, the car repair that arrives the same month as the appliance. Let both accounts exist simultaneously. Fund both before you buy furniture. This is the first-year survival plan in its entirety. Lifestyle inflation is the enemy that waits until you have keys in your hand. The mortgage payment is higher than the rent was. The temptation is to let everything else expand with it. Resist it for 12 months, 18 if the budget is tight. The house will still need things in year 3. Your ability to pay for them depends on what you did not spend in year 1. Refinancing becomes worth exploring when rates drop at least 0.75% below your current rate and you plan to stay long enough to recover the closing costs. The break-even calculation is simple. Divide the total closing cost by the monthly savings. That is your break-even in months. If your time horizon exceeds it, you run the numbers seriously. If it does not, you wait. House hacking, renting a room or a unit to offset the mortgage, is not for everyone, but it is the fastest legal way to reduce your housing cost to income ratio without selling. If the duplex was the right first property and you're willing to do it, the number it produces can restart investment contributions years earlier than the standard path allows. That earlier restart compounds longer. The math on that is not close. You are in the house. The mortgage is real. The question that arrives next is quieter but just as consequential. Do you pay it off as fast as possible, or do you let it run while your money works harder somewhere else? The answer depends on your rate. This is not an opinion, it is arithmetic. If your mortgage is at 7% and the long-run real return on a diversified index portfolio is approximately 7%, the decision is essentially a wash before taxes and risk tolerance are factored in. If your rate is 3.5% and you locked it in during a window that no longer exists, paying it down aggressively is almost certainly the wrong mathematical move. Every extra dollar toward that principal earns you 3.5%. Every dollar in a broad market index fund has historically earned more than that over long holding periods. The rate on your mortgage is the guaranteed return of paying it down early. Know that number. Compare it honestly. The emotional weight of a paid-off home is real and legitimate, but it should be a conscious choice, not a default. The bi-weekly payment myth needs a clean burial. Making payments every 2 weeks instead of once a month does produce one extra full payment per year. That is true. It does meaningfully shorten a 30-year mortgage. That is also true. What is not true is that there is anything magical about the bi-weekly structure itself. You get the identical result by dividing your monthly payment by 12 and adding that amount to your principal every month. One extra month's payment per year. That is the whole mechanism. You do not need a bank program to do it. You need a line on a check labeled principal only. Before you apply any extra principal at all, run the break-even check against your current rate. If you have high interest debt, that disappears first. If your emergency fund is not fully capitalized, that comes before extra principal. If your employer match in the 401k is not fully captured, that comes before extra principal. Those three things have a higher guaranteed return than paying down a 4% mortgage. In that order, every time. The upgrade question arrives somewhere between year 5 and year 10 for most buyers. The first home becomes small or inconvenient or both. The equity has grown. The temptation is to sell, roll the equity forward, and buy something larger. Before you do, price the transaction cost completely. 6% commission on a sale, closing costs on the purchase, moving costs, and whatever the new house needs in year 1. On a $320,000 first home, $120,000 first home, the friction of that move can easily consume $30,000 before you have signed a single document on the new property. The equity transfer is real, but it is not free. The alternative some buyers pursue is holding the first home as a rental. This is not a decision to make based on sentiment. Run the numbers as a landlord would. Gross rent minus vacancy allowance minus property management minus maintenance minus insurance minus property tax. What remains is your actual return on the equity trapped in that property. If that return is lower than what the equity would produce in the market, you're making a lifestyle choice, not a financial one. Both are acceptable. Neither should be disguised as the other. Risk management compounds quietly in the background when everything is fine and becomes the only thing that matters when it is not. Adequate homeowners coverage is not the cheapest policy available. It is the policy that fully rebuilds your home at current construction costs in your specific market. Those numbers diverge significantly. Review your coverage limits every 2 years. Keep the maintenance reserve funded continuously, not reactively. If income is variable or your field has exposure to layoffs, consider a larger emergency buffer, 9 months instead of 3. Your mortgage does not pause. Your reserve has to cover the gap. Track 2 numbers every year without exception, your mortgage balance and your home's estimated value. The difference is your equity. That equity is your eventual launch point, whether toward a forever home, a paid-off retirement, or both. When rates drop at least 75 basis points below your current rate and you plan to stay beyond the break-even horizon, refinance. When your equity crosses 20% of the original purchase price, remove PMI if it was ever applied. When the mortgage is gone, redirect that payment immediately and completely into the portfolio. Do not let it dissolve into lifestyle. You spent 30 years building that cash flow. Treat it like the raise it is. Pick your current level in this sequence. Write down the next 2 actions that move you to the next one. Then take them this month, not next. Subscribe if you want the next breakdown built specifically for where you actually are.